What's
right, we are
going on,
live.
y'all? Oh, Nate. Well, what
I
do
don't
you
know.
got me on here for then? Pepto? Go ahead, rock and roll, buddy.
No, I was just saying we're live, and then you started talking. So perfect intro. Look at that.
Well, I thought I was paying attention, supposed to do the finger roll thing you always tell me to do.
Oh yeah,
And then
I
I
do.
did it, and now I feel like I shouldn't have. So,
Hold on, let's start over.
okay.
Okay, we're back. Go.
Oh, now I'm okay. What's happening, y'all? Christopher Griffith here, Vetivier. Hope y'all are having a good day. As always, on Monday, we are bringing you information about what's going on in the mortgage interest rate world, right? Because there's a lot of things that play into it. There are a lot of different things that change really dynamically and can change outlooks from one week to the next. And we want to do the best that we can, as always, to keep you informed to the best of our ability. So, well, as you know, Hammer over here and Nathan certainly as well. We're going to do it all three of us today because we just all happen to be in the right spot. But Hammer, why don't you tell us where we were last week? What has happened since we last talked over the Turkey Day and where things are looking like?
All right. So, Nathan, you mind do me a favor? Show my screen if you can.
Yep.
And hello, everybody. Hope you guys had a fantastic holiday. Hope everybody enjoyed their family, friends, maybe getting together a little more than we did last year. So actually, there's quite a few things to touch on. And last week, Nathan and I talked about, we were going to talk about the secondary market today. And what the secondary market is, we're going to talk about what happens to your mortgage after it closes and how that works financially and how it all affects mortgage rates. And what happened last week actually will roll us right into that conversation this week for that, because last week we had a very interesting reaction in the markets while everybody was basically off for the week after Thanksgiving on Friday. We had an interesting reaction. So a quick recap. Last week, rates were a little more erratic. So we started the week and rates were getting a little bit worse on Monday, a little bit worse on Tuesday, a little bit worse again on Wednesday. And it looked like we were pretty steady into that trend. And it was a trend we had talked about the week before. We kind of expected it. We expected it because of what was going on with inflation, what the expectations were with the Fed. There was the idea that the Fed may look to raise interest rates sooner than June of next year. And that was kind of the forecast. And all of that basically pushes on mortgage rates and causes them to creep up a little bit at a time. However, what ended up happening last week is on Friday, we had a big scare, or, I guess, announcement with COVID, and that was about Omicron. So I think many people are familiar with that name now, Omicron. It is a Greek letter. All of the COVID variants have actually gone in
I'm just curious, Vets, if you watch this, mention it in the chat. When you first heard that Omicron, did you think that we had some like landings of Transformers, the bad ones, right? Decepticons?
Right. I was going to, Decepticons and Omicron. Actually, and again, for anybody that is watching today, we're going to talk COVID because COVID is the main driver for interest rates this week and for last week and this week. And when we talk about COVID, I'm going to just kind of really treat it as a conversation of how does it affect the financials. We're not talking about vax or no vax or, mandates or anything like that. We're going to, even though we're talking about what could be construed as a political or controversial topic, we're talking about how it actually is going to play out this week on mortgage rates and what effect it had last week. And it's really important because it is the main driver for what's going on. So on Friday, we did see this announcement that there was a new variant, and it was actually one that the World Health Organization is now tracking as a variant of concern. So they put them into these, red, orange, yellow. What do you call that, Christopher, when you've got those different stages of levels of how prepared you are, or how big of a threat something is?
Threat identification system. I don't know.
Yeah, but you guys know what I'm talking about. The guy that goes yellow, then orange, then red.
It's just simple. It's colored based, and it's usually around like, red's usually bad, right?
Yeah, red's usually bad. So that's what the World Health Organization has on COVID, and they've got these different variants. And again, we've been running through the Greek alphabet. So we've got alpha, we've got beta. The one that's, of course, takes all the headlines today is delta. But the ones that are currently variants of concern are alpha, beta, gamma, delta, and now this Omicron. And the Omicron, this newest variant that has jumped up in the ranks and is now a variant of concern, it popped up in South Africa. And the big thing wasn't that we had a new variant of COVID that freaked everybody out. What freaked everybody out was, at least in the financial markets, was the reaction that all of the different countries had and how quickly they were shutting down travel and banning people from coming in from South Africa and other countries within Africa in that southern area of Africa. And this was a big concern on what effect is this variant going to have on the global recovery, the global economic recovery. So as the economy in the world is improving, and especially the US economy, that's going to push mortgage rates higher. When the economy is going to improve, that's going to lead to just a lot of reaction, like we've talked about in the past from the Fed, where they're going to push to keep rates down. They're actually going to allow rates to creep up, rather, because that'll help keep inflation in check and the economy is doing well. So with this introduction of this new Omicron, it was, in my opinion, a knee-jerk reaction. It was a bit of an overreaction. And what we saw is on Friday, we saw a really big move in interest rates that they actually improved. Now, I'm going to go deeper. And Christopher, you've said that it's okay to kind of really get into the technicals on this and talk about what drives interest rates and educate everybody. But if I start getting into Snorefest region and things start to get a little too jargony, please stop me and slow me down. Is that fair?
Yeah, sounds great.
Okay, so if everybody looking at my screen here, what you're seeing is what's called a Japanese candlestick chart. And what we're watching mortgage bonds, specifically what's called a mortgage-backed security. And these, as I've talked about before, these mortgage-backed securities are your basis for where your mortgage rates come from. And Christopher has pointed out that different lenders will have different margins, what they need to make and their expenses, but they're all going to stack that. That's the icing on top of this cake. And the icing may be different thicknesses, but the cake is always the same. And this is the cake right here. So what happens is when you see these red candlesticks and we move in a downward direction, mortgage bonds are selling for a lower amount. And that means that mortgage rates actually creep up. That's the relationship. So what happened is that going into Thanksgiving, we had a red day here, which is rates getting a little bit worse. Then that was a Friday. Then on Monday, we had another red day, rates get a little bit worse. Then we had Tuesday and Wednesday. So this trend was one that said, hey, rates are kind of creeping up, not a big move, but we're going to see them get a little bit worse. And that's what Nathan and I talked about last Monday. I said, hey, heading into this holiday next week, we're very likely to see rates that are going to be worse. Well, what happened is this curveball was on Friday. And you could see this giant green line, this green candlestick, as it's called. This is where things improved quite a bit. And they went from this lowest point down here all the way up here. And what that does is that sets the stage for mortgage rates to improve. However, we didn't see mortgage rates improve nearly as much as we saw these mortgage bonds improve. And there's a reason for that. And that kind of gets us into that conversation about the secondary market. So we'll kind of lead right into there. So what happens is that on the back end of the markets here, mortgage bond pricing is improving. But this is only going to benefit directly to the lenders. The lenders are going to get a little bit more money as they sell mortgages to replenish their finances so they can keep lending. So what I'll do is let me jump over to this and I'll kind of draw this out for you. So when you actually close a loan as a consumer, and let's say that you go ahead and you get some cash in your hand, right? And this is your cash that you need so you can go ahead and buy your house. And again, don't judge my drawing skills because they're not there, but you guys will get the point. So
the Marines are going to love this part. This will be the first one of these where Marines are like, oh my God, now they're doing it. Thank the
Lord. There you go. So we got something on here. So what happens is the money that's going to be used to buy the house, you'd run out of money. Banks have money, but they only have, let's say that they have a little pyramid this high. So they've got a stack of money, but that's not enough money to keep lending and keep lending and keep lending. So what happens is a bank, as it's commonly said, but it's actually a lender because they don't have to be a true bank, but a mortgage lender, and we're just going to put MTG lender so everybody knows what we're here. So a mortgage lender, what happens here is they're going to actually lend money to the consumer, to you guys. Let's say they do your VA loan, right? And they're going to go ahead and they're going to give you the money to buy your house. So you're happy. You've got a happy family here and you guys are happy. I told you I wasn't great at this, but I could at least give my eyes. And you're buying your house. The mortgage lender, in order to make sure that they don't run out of money, is now going to actually sell your mortgage. And what they do is they put your mortgage together with a bunch of other mortgages and they stack them all up. And then they get broken up into a little piece of pie. And these pieces of pie are securities and they're sold in the bond market. And that's going to be done depending on what kind of mortgage you get. If you're getting a VA loan, it's generally through something called Ginnie Mae, which doesn't get as much press as her bigger sister, Fannie Mae, or her brother, Freddie Mac. So these organizations, they're the ones that actually take the loans that were done by the mortgage lender. They put them together and they stack them all up into a giant multi-tiered cake, and then they cut them and slice them and they sell them on the bond market. And that's what replenishes all of that money. So what we're looking at on this screen here is what they're actually able to sell a piece on the back end for. And how that works is they're going to say, okay, well, we've got $100 worth of mortgages right here. You can buy a bond. It's a $100 bond. And that bond is going to give you a 2.5% return. So if you're looking for somewhere to invest your money and you're an investor, you can invest it in stocks. Stocks are doing really well right now, especially if you know which ones to pick. You could throw them in Bitcoin. But if you want to be a little bit more conservative and you want to protect your investment, you'll get a lower rate of return, but you can invest in bonds. And some of the best bonds, the most safe bonds, are US Treasuries. A US Treasury is guaranteed by the US government, so it will not default. So right now, a yield on a US Treasury, on a 10-year Treasury, is 1.52% or 1.53%, basically, we round it up. So your yield is based on how much you're able to actually sell that bond for and how much it's going to be making over time. So if somebody buys $100 worth of a mortgage bond and it's giving a return of 2.5%, that means that for the next 30 years, in theory, you're going to get $2.50 on your $100 return. And then at the end of 30 years for letting them use your money, you're going to get your $100 back. So that's the interest that you're making on those bonds. But what happens is there's a supply and a demand for those bonds. And what that does is somebody will pay a premium for this $100 worth of bonds, and they'll buy a premium. So when I say they're going to do a premium, instead of buying a $100 bond and getting a 2.5% return, if that 2.5% return is a really good return today, I may pay $101 or even $102. And that's what we're actually monitoring right here, is that right now somebody is willing to pay $102.39 to get a $100 bond. Why would they do that? Why would they pay this premium of $2.39? Well, because they're paying the money up front because they're getting a better rate of return of 2.5% over the life of that coupon, of that bond. So depending on the demand and the supply, how many lenders are putting into the pool and how many people are looking to buy these bonds, that's what drives the bond prices up and down. And by monitoring those bond prices here, that's where we get an idea of which direction mortgage rates are headed or where they're going to be at any given time based on the performance of these bonds. So that's kind of the background there. Now, what happens is for the lender is trying to make a profit. So what they're going to do is the lender is we'll call them the middleman. And the lender is going to go ahead and lend the money to you as a consumer to buy your home or refinance. And then they're looking to kind of make some money on that money as they sell it back onto the bond market. So I'm just going to put bonds here so everyone can see here. So this is where your lock desk or your secondary department come in. And that's kind of where it gets a little bit confusing for most people. So we'll slow down and we'll kind of just make sure everyone's clear on this. So what happens is, as a consumer, you're at some point going to be able to lock in your interest rate. When you lock in your interest rate, you're saying, okay, I'm going to get my, let's just call it a $300,000 loan. And I'm locking this in at 3%. And these numbers are just for round numbers. They're not necessarily what you should expect to see for interest rates today, but they're within the vicinity, right? So they're going to lock in an interest rate at 3%. So the lender is going to say, okay, we're going to guarantee you this 3% and this $300,000. This is what we're going to give you as a guaranteed locked in interest rate, no matter what happens on this market back here as things go up or down. And then what happens is the lender is now either going to hold that lock or they're going to sell that lock. So, and that depends on which direction things are headed. And that's where they make their money. And this is called hedging. So what they're doing is they're promising that money to you at a particular rate, which they will guarantee no matter if they make money or lose money. They're going to then take that same loan and they're going to sell it into the securities and into the bond market. And they're going to maybe either make a little bit of profit by selling it at a higher premium, or they're going to lose money if they sell it at a lower premium. And what happens is that's called TBD, which is to be delivered. And that's when they're selling them forward. So they're basically the middleman that's saying, okay, on the securities market to Ginnie Mae. Remember, those are the ones we talked about over here. If I go back, come on, wake up. There we go. These are Ginnie Mae, Fannie Mae, and Freddie Mac. They're going to be selling to one of these, depending on which loan program you're a part of. And if you're a VA loan, that's a Ginnie Mae. And then they're saying, okay, we're going to promise to give you this loan in the next 30 days. We're going to give you a $300,000 loan, and the interest rate that is going to be 3%. And that they're going to say, okay, what will you pay us for that? So that's where that premium again comes into play, because as the bond market, as this gives a better premium, the lender makes a higher amount of money. As they sell that $100 worth of bond, they're making 102.67, let's say, or 102.94 if they get up this high, or 103. So right now they would be, and again, this is still an oversimplification. It is a little more complex than this, but just for the idea, they would be making $102.41 on that $100. So 300,000 at 102, whatever we talked about. So, gross it up there. So 300, and then, 60,000, right? So, or 6,000. So that's where they would be making on that. And that's where your secondary department comes in. And the reason this is all kind of relevant now more than ever is when there's a big swing in interest rates, these guys are caught in the middle. And they're kind of caught holding the bag. So what happens is with some lenders, they have what's called a float down policy. So in order to kind of give consumers a reason to lock in their interest rate, but give them some kind of protection, they'll say, okay, we're going to lock in that 3%. But if rates go down, we'll give you the lower rate. But that lower rate has to be at least, and generally it's going to be about 0.25% is usually a pretty good average. So 3% would have to be 2.75. And if rates drop to 2.75, we're going to go ahead and we're going to forget about this and we're going to give you that 2.75. However, if rates only go down 2.875, then you're still at 3%. So that's kind of how float downs will often work. So what happens is that the lender has to now look back. When we see a very, very big move like this green candlestick here compared to, say, these smaller green ones like here and here, these are small movements. The lender can kind of work with those. When we see a big movement like this happened on a Friday. So interest rates did not all of a sudden get 0.25% better on Friday because the bond market got 0.25% better. What happens is that lenders will kind of sit on this because they're concerned now and they say, okay, a couple of questions here. Number one, is this going to last? Is this for real? That's the first thing they want to know is this for real? Are we going to have time to get loans in and sell these loans back out on that secondary market? Or are we going to get stuck holding the bag? The second thing is this going to cost us money? And it's not that they're greedy. Sometimes, if you don't own the mortgage bank, it's easy to look at it and say, hey, they're greedy. But no, they're not greedy. If they're a company, they're a business, and they have to make a profit to stay in business. So what'll happen is if they've done a lot of loans and they've locked in a lot of loans at that 3%, and if they drop their rates to 2.75, well, first of all, why do they drop interest rates? Is it because they're altruistic and they want to give you the best rate? No, it's not. Not that they want to cheat you, but they don't want to give you the best interest rate. Their concern is running a business and doing so with integrity, but it's not necessarily always coming back and giving you the best interest rate as the consumer. The reason that they lower their rates is to keep new business coming in. They have to stay competitive. And that's why, Christopher, I think there's a philosophy you have about consumers shopping around. Do you want your vets shopping around?
I would say yes. Good Lord, yes. I think we talk about that more than anything. The number one, the CFPB says it, like professionals that are knowledgeable see it. You guys and gals, the number one thing that you can do to make certain you're getting the most competitive interest rate to par to where the market's at today is shop. That's all you have to do. And it's not very hard. All of you are afraid that by shopping, your credit score is going to get hammered and it's going to make you not qualify, which is not true at all. You may see if you have tons of inquiries, like say if like 10, 15 inquiries in different categories, maybe then you see a small adjustment to your FICO score, but it's not massive. More than likely, the balances that you fluctuate and moderate on your credit cards relative to their maximums, your debt utilization ratio, right? That's going to impact your score quickly, but the other likely won't, especially if it's all categorical and mortgage based. They're going to allow you, and they understand if you're shopping, it shouldn't harm you because you're doing the thing that literally you ought to make certain that you're setting yourself up for the best situation possible with being in a competitive spot with your interest rate. So I guarantee you this, if you didn't shop, you didn't do as well as you could have. That's nearly perfectly always true.
Yes. And I agree with that. And that's what's happening here. So lenders will lower their rate because they want to make sure they stay competitive when you're shopping around and they bring in new business. But they also have to be careful that they don't lower their rates too much, because all of these people that had 3%, they've promised them 3% and they've most likely booked that business. They've promised it forward and they're making money on it. And now if they lower that rate, they still are on the hook to the investor for providing the loan that they promised at 3%. And they have to eat the difference. So what often happens in a scenario like this, when we see a lot of big moves, is that you're going to see couple of things happen. Number one, most lenders are very slow to pass along the gains. They'll do it in increments. So what that means for us is that we're likely to see some improvement to interest rates. And I'll use, this is just a chart to kind of get an idea. So on the 24th, which was Wednesday, we were at 3.29, and this is just an average blended rate. It's not just something to go by, kind of to give us some a base level. And then on Friday, it was 3.24. Now, with what we were looking at on the back end of so there's a picture of my Christmas tree. What we were looking at over here on the back end of the market, we would very easily see that actually go much lower to like maybe 3.12. And instead of going to 3.12, you say, well, why are we only at 3.24? Because on Friday, we were at 3.24. Today, on Monday, that 3.24 is likely to improve to maybe 3.19. And if we see that that mortgage bonds continue to stay in this range and are selling for a premium, we will see that lenders will continue to pass those along and will do so in the increments that they need to stay competitive and get new business without costing them money on the float downs. And not to say that they won't lower rates and do float downs. It's just that they have to be careful. When they're managing millions and millions and millions of dollars in pipeline, this adds up quick when you have to eat the differences in the increments. So when you're shopping around today, and this is kind of where we can, wrap up with, is for this week, let me go back to my other slide. So for this week, we want to go ahead, and it's tough to forecast how this week's going to play out for mortgage rates. It's going to depend on how markets continue to react to this new COVID issue. And again, we're talking about COVID a little bit. This particular Omicron, the doctor in South Africa that was responsible for identifying it, her name is Dr. Angelique Coetzee, or I may be totally killing that, but you guys get the point here, right? Coetzee, Angelique Coetzee. All right. She's also the chairwoman of the South African Medical Association. She recognized that the patients who got this had different symptoms than the Delta strain. The Delta infections were, causing elevated pulse rates, resulted in low oxygen levels, as well as the known loss of smell and taste. This newest version, though, is seems to be maybe a little less severe, and it causes fatigue, head and body aches, and occasional sore throats and coughs. So as this becomes maybe less of a concern, we'll see markets start to loosen up again. Because if it's a big concern, if everyone around the world is very concerned about this, we're going to see a lot more of the continuation of seeing lockdowns and seeing travel restrictions and stopping people from crossing borders. And that's all the things that are going to really put a damper on the economy, especially for tourist areas like Thailand. So now, if we see that, hey, this particular variant isn't so bad, even if it's highly contagious. And think about it, wouldn't it be crazy if it's more contagious than Delta, but it results in a less severe sickness or illness? That would actually be a good thing, because more people would get sick, but they'd be less sick, and we could, more of a herd immunity, if you will. Also, everybody on the scientific front wants to see, how does this particular variant react to the current vaccines, and I'm sure we're going to see some more information about all of that. So if we see the concerns about this Omicron rise, then most likely mortgage rates would actually improve a little bit. Things are going to, because what happens with investors is they're concerned about profits, they're concerned about companies, concerned about all the stocks. They take their money out of stocks and they put them in bonds. And because they have that safe guarantee, may only be 2.5%, but it's a guaranteed 2.5%, or as close to guaranteed as you're going to get. So that's what they're looking at. So if it's a big issue, we're going to see bonds could improve, which could mean pricing improves, our rates improve a little bit. Are we going to go back down into the twos? Most likely no. And again, depending on where your lender is pricing now, you'll see an 1/8 to maybe 1/4% in interest rate improvement if we can continue to see this take the path that it's taken. If, however, we start to recognize that maybe this variant is more benign and countries begin removing their travel restrictions that were recently set into place, then we're going to see rates creep back up a bit. And that's kind of what we're looking at. The other things that are going to be important this week, days that you want to circle on your calendar, economic data wise, we're going to get data on Friday. And the data that comes in on Friday is the jobs data. It's going to be about unemployment. It's going to be about new jobs that were created, non-farm payrolls, and it's going to be about wages. And the data that comes in on Friday is likely to have more of an effect on mortgage rates than any of the other data this week. And that's because investors are looking at that data and saying, what is the Fed going to do? Because the Fed's mandate is to worry about employment and inflation. And we already know the Fed has to worry about inflation. Inflation is an issue. And in order to control inflation, the Fed would need to raise rates. That's how you fight inflation. And the Fed is currently expected to do that in June of next year, 2022. If we see unemployment continue to improve as it has been and jobs are created, that's the Fed's second mandate. And if that's going well, that supports the Fed raising rates, and it means it could happen even sooner than June. So even though this is 6-7 months away, investors and markets will actually react to that news now, trying to think about where things are headed and what's going to happen. So that's what we want to watch this week, is how the markets react to this COVID variant Omicron. And on Friday, we're going to want to watch that jobs data, because that's likely to have a little bit of an effect on rates and pricing as well. And as far as shopping goes, if you got price quotes last week, it's very important that you refresh those price quotes. Talk to those lenders again, find out where they're at. In some cases, they may be a little bit better. In some cases, they may be a lot better. So before you're ready to make your choice and lock in your interest rate, definitely refresh those rate quotes. This is where the market moves, and you could see that things do get a little bit more volatile. How's that, gentlemen? Anything you guys want to add or question?
That was super solid. I would also say, though, that if you locked your rate last week, I wouldn't freak out. You were talking about incremental change, right? So we're
yes,
not
I agree.
About
Great
massive
point.
swings. This isn't where you need to go back and go, I want out. I want to switch, right? You're talking about very incremental position points. So what I fear is that anybody listening to this goes, oh no, I locked last week. I'm dead. I'm dead in the water. This is terrible. It's like, no,
Yeah.
you're not. Okay.
Pennies on the
Number
dollar.
one,
Great point, Nathan. Great point.
Less than pennies, actually. I mean, we're so small when it comes to your total borrow amount. So just to clarify.
Yeah, no, great, very good point.
No, I thought that was a solid deal. I think a lot of the members will probably include some of the writing, the pictures, the drawing out of it. I think it helps on these kind of subjects, at least if anything else, to follow along. Maybe I think maybe one more thing important or significant are the number of job openings that there actually are. That probably speaks to the likelihood or the potential opportunity for jobs numbers to continue to improve, which they're already, I think, a really, really great place, right? So I don't know. We'll see where it all goes, but I don't think, as we've been saying, it isn't anything that any of you should feel stress from in any way, shape, or form. The one thing that you can do, which your feelings, quite frankly, are ridiculous. They don't matter. They're feelings, ladies and gentlemen. Not to say that they don't matter. They're not significant to the problem that you have. The one thing that you can do if you have feelings of action to take hold of things that can change or impact those feelings is shop. That's the one activity that you can do to cause change to the thing that you may have feelings around. So don't focus on your feelings, focus on the activity, the things that you can do to improve your circumstance. Ladies and gentlemen, as always, we appreciate your time, attention, questions around these types of subjects. I thank you for breaking down the Japanese candles. This is gold. Brian Dick said we speak in pictures. I think that was probably more impactful this time. I think that it'll be really interesting to see where things go this week and next. As always, we'll follow this chat or this video. If you have questions, post them in here after the fact. Any of us can jump in and make sure that you are able to understand the things that are impacting you daily. Anything else?
Not for me. Fantastic. Thank you so much.
No, it's great.
All
I appreciate
right,
it,
all
Helmer.
right,
Hope
all
you have hope you guys have a good week, and we'll talk to y'all soon.
Blessings, y'all.
Take care.